Remember back in early 2021 when GameStop, a struggling mall video game store, suddenly exploded in price? We're talking about a stock that went from around $20 to over $400 in just a matter of days. Overnight, everyone was glued to their screens. Reddit was flooding with rocket emojis, memes about diamond hands, and endless hype in places like Wall Street Bets. You had YouTubers shouting, "Hold the line!" headlines blaring, "Hedge fund loses billions," and Wall Street scrambling to understand what on earth was happening. It wasn't just a price spike, it was chaos. It was a battle. But here's the real question. What made these billionaire hedge funds so vulnerable in the first place? Why were they fighting for their financial lives against a bunch of retail traders on the internet? The answer is one of the most dangerous strategies in the stock market: short selling. Today, we're breaking down exactly what short selling is, how it can make or completely destroy fortunes, why it's so controversial, and how the GameStop saga exposed just how dangerous this strategy can be. Welcome to Martic Finance, where we explain investing concepts in a simple way. But first, a quick disclaimer. This is not financial advice. All right, so what is short selling? Most of us know the classic investing idea. Buy low, sell high. You buy a stock, it goes up, you sell it, and you profit. Short selling flips that upside down. Instead of betting a stock will go up, you're betting it will go down. Let's use a super simple analogy. Imagine there's a brand new gaming console everyone's hyped about, but you think the hype won't last. You believe the price is about to crash. You don't own one, so you borrow a console from your friend and promise to return it later. You immediately sell it for $500. A week later, the hype dies and the market price drops to $200. You go to the store, buy that same console for $200, hand it back to your friend, and keep the $300 difference. That's short selling. You profit when the price falls. But what if the price had gone up instead? Say it doubled to $1,000. You'd still have to return it to your friend. Suddenly, your $300 profit turns into a $500 loss, and there's no real ceiling on how high it can go. That's why short selling can be thrilling and terrifying. Now, let's translate that analogy to actual stocks. First, you borrow shares from your broker. You don't own them, you're just temporarily borrowing. Then, you sell those shares at the current market price. Next, you wait and hope the price goes down. If it does, great. But if it rises instead, your losses start adding up quickly. When you're ready to close your short position, you buy back the same number of shares, ideally at a lower price than what you sold them for. Finally, you return the shares to your broker and keep the difference as profit. There are a few additional details worth knowing. Borrowing shares usually happens through a margin account, and brokers may charge interest on the loan. If you hold a short position too long, those costs can accumulate. Timing is crucial. A small misstep can turn a potential profit into a major loss. Here's where short selling gets dangerous. With regular investing, the worst-case scenario is simple. The stock goes to zero and you lose your investment. Painful, but capped. With short selling, the risk is unlimited. If the stock rises instead of falling, you still have to buy it back to return the shares you borrowed. And since there's no limit to how high a stock can climb, your potential losses are theoretically unlimited. This sets the stage for one of the most dramatic market events, the short squeeze. Let's return to GameStop. Hedge funds had bet massively that GameStop would fall. They shorted millions of shares, in some cases more shares than actually existed, over 148% of available stock. When the price began to rise, even a little, short sellers started to panic. The higher the stock went, the more they had to buy back shares to limit losses. Here's the twist. When all the short sellers start buying shares at the same time, that buying pressure pushes the price even higher, forcing even more short sellers to cover. It becomes a self-feeding loop, a financial chain reaction, known as a short squeeze. During the GameStop frenzy, this squeeze sent the stock from $17 at the start of January 2021 to an intraday high of about $483 in just a few weeks. Hedge funds felt the pain immediately. Melvin Capital lost over $6.8 billion, wiping out more than 50% of its portfolio in a single month. Citron Research, a firm known for short selling, publicly announced it would stop issuing short reports after being badly burned. On the other side of this financial battlefield was a retail trader live streaming from his basement. His online name was Roaring Kitty. He had been analyzing GameStop for over a year, posting research, spreadsheets, and videos. He genuinely believed the company was undervalued, put his own money in, and held his position even as the price went wild. His streams, memes, and updates inspired thousands of retail traders to hold the line and buy into the movement. Later, Gill testified in front of Congress, explaining he never intended to manipulate the market. He simply believed in the company. So why did GameStop's stock go parabolic? The main reason is that it was one of the most heavily shorted stocks in the market. With more shares being shorted than actually existed, there simply weren't enough shares available to cover all the short positions. When retail traders started buying and holding shares, the short sellers were forced to buy back shares at ever-increasing prices. That buying pressure created a vicious upward spiral, forcing more short sellers to cover, which pushed the stock even higher. Now, let's talk about the ethical debate. Short sellers are some of the most controversial players in the market. On one side, you have the villain perspective. Short sellers profit when companies fail. Critics argue that some of them root for layoffs, bankruptcies, and bad news. Some go further, spreading negative rumors or attacks in the media to push the stock down. From this perspective, they're the villains of Wall Street, making money from the suffering of others. On the other side, there's the hero perspective. Short sellers have exposed some of the biggest corporate frauds in history. They were among the first to call out Enron, Lehman Brothers, and Theranos, helping prevent massive losses for regular investors. By uncovering overvalued or dishonest companies, they act as financial watchdogs, keeping the market honest. So, which is it? Are short sellers ruthless profiteers tearing companies down, or essential truth tellers preventing disasters? The debate is as old as the practice itself, and it's unlikely to have a clear answer. So, what can we learn from all of this? Short selling is a high-risk, high-reward strategy, and it's not for the faint of heart. And ethically, short sellers occupy a gray area, either necessary truth tellers or ruthless opportunists. The GameStop saga reminds us that markets are complex, unpredictable, and influenced by both psychology and strategy. Next time you see a stock suddenly spike or crash, remember, there's often more happening behind the scenes than just ordinary buying and selling. And that's all for today. I hope you found this video helpful. If you did, please consider subscribing and liking this video to continue growing this community. Thanks for watching, and I'll see you very soon. Bye.